Joining us now on inflation, the market's strong performance in the first quarter, and much more. Gabriela Santos, Chief Market Strategist for the Americas at JPMorgan Asset Management. Good morning.
Good morning.
He had Roger Ferguson on, and I think the general perspective right now is that inflation is still a little sticky, but no one expects it to really turn around and head higher or to stay like this for a long time. The idea that we could actually need to start another rate hiking cycle is not on anyone's mind. So if we are at this point where, we get we get a few bad data points, but we're trending in the right direction with these great earnings and with this great economy, why not stay long? But I would think the minute that it became clear that the Fed is not, if they aren't restrictive here and actually would need to raise, I think that could probably throw a wrench in the works.
I agree 100%. If we go back to the higher for longer kind of discussion, that would be an issue. For now, we're in a high for longer discussion, which means rates can stay at these elevated levels, but the next move is a rate cut. I think what was really damaging last year was the idea that we're not entirely sure how far the Fed is willing to take rates higher and hence damage the economy in its inflation fight. And I think the December FOMC meeting, which was emphasized again at the March meeting and in Powell's speech last week, is that really they're not willing to sacrifice the economy to get inflation to 2% in a shorter timeline. They're okay with bumps in the road. They're okay with inflation getting to 2% over a 2-year time horizon. And we don't have to fear. We can actually cheer resilient, strong economic data. And that's what I think is behind these all-time highs in the market. And most importantly, the broadening out in the performance, where we've started to see cyclicals participate.
So you think high for longer?
I think that's much more manageable. And you can see that in corporate behavior as well. For companies, what was really damaging was not really knowing how high the cost of capital could go. Once you have a better feeling of around where it can be, you start to see more bond issuance, M&A, IPOs, and hence it really opens up capital markets, and that's a good thing.
Because we went from 6 cuts, and then we went maybe 4, and maybe now there's 3, and there are people talking about 1 cut that we heard, or now none, and the market hasn't moved at all. So somehow I was able to digest that and go up 100 points every day.
I think that's a good thing to see that the stock market is not held hostage
by the
daily moves in Fed pricing expectations or even the 2-year, the 10-year. That's a good thing because it means investors are going back to focusing on fundamentals, on earnings. And it also signals a focus again on resilient nominal growth and hence a broadening out in earnings growth as the year progresses from just that Mag 7 earnings growth, which was the story last year, to much more of a broadening out in the recovery of earnings as the year progresses, and hence more participation from different sectors.
There are things on the horizon, near-term and long-term geopolitical things. I don't know where you want to start. Like Taiwan, I mean, so many things. Ukraine, Taiwan, the Mideast. Yeah. We've got, this huge amount of debt overhanging. Is there a productivity solution to some of our debt issues here or is that just so far off that we'll get whatever that expression is? Was it Thomas Aquinas or Thomas More? I'll get chased down, just not today. But I mean, we're fine now with $33 trillion in debt. Keep buying stock.
I think what we learned in the middle of last year is there is a focus on the elevated level of the deficit and hence on Treasury issuance when we had that freak out in the middle of last year as a result of elevated Treasury issuance. And I think that's one of the reasons for us that we don't expect long end yields, so think 10-year plus, to really deviate from this range that they've been in since the end of last year. Let's call it 375 to 425 until there's eventually a recession. That's incorporating a certain premium for all this Treasury issuance. Now, the risk later in the year, we think, is as we get closer to election season and we actually start hearing more from former President Trump and President Biden, as well as the general proposition for what to do with the individual tax cuts worth $2.6 trillion, which are set to expire at the end of next year. And then that could lead to even more of a focus on even higher deficits and more Treasury issuance.
Gabriela, I just go back to this issue of if inflation starts to get higher, are we really facing a Fed that's not going to do something about that? And then not just this Fed, what happens if there's a change in the administration and there's a new Fed chief who comes in 2026 or maybe sooner? It seems to me that all of these politicians are listening for the litmus test being, are you going to be easy on rates for the next Fed chief, whatever they look for? I think Powell's a different case. He kind of does what he wants. If you've got somebody else in there, is anyone going to be able to say, no, I'm going to do what needs to be done for the case for inflation? And maybe that's a different way of looking at things.
I think for us, we do think the Fed is independent in its mandate and is really focusing.
Jay Powell is too.
I think if you start politicizing central banks, that doesn't tend to end well. We've seen that time and time again in emerging markets, and we hope that doesn't become the case here. I think in terms of inflation, if we're where we are, which is just, as Chair Powell said, bumps in the road on the journey towards 2% over a certain multi-year time horizon, that's okay. I think the danger does become, Becky, if inflation expectations start to become unanchored again, either because inflation starts to come in higher or gasoline prices continue moving higher.
Or wages continue to climb like they're doing. We're talking about
without or real wages continue to move higher, but without the accompanying improvement on the productivity side. I think really the thing to watch is inflation expectations. And the good news is when we look at the Michigan Consumer Sentiment Survey is so far, actually, inflation expectations are moving lower. And I think that does give the Fed comfort to wait out the disinflationary process.
Do you think Jay Powell is going to be in this job? How long do you think he's going to be in this job? Do it that way. No, seriously.
Yeah, I think it will depend on the new administration and whether
if the current administration is the administration in the future, he would get another jump?
I'm not sure. I think it certainly is not an easy job.
And don't you think it's politicized already? I mean, when Kevin Warsh comes in here, he has his own very different views about what to do, and they, at some level, underneath it all, are somewhat political. Having said that, you could say that Jay Powell was political insofar as he's now been on two political sides of it.
We would prefer less Fed speak, personally. I think it is a lot of daily commentary to digest, and we already have quite elevated volatility across the yield curve, but it is what it is. And we do tend to look through some of the day-to-day noise and just focus on Chair Powell, which has been very focused on building consensus in the committee. But let's see what happens with the new administration. I don't think we're at the point where you see in emerging markets, the president just tells the central bank what to do. Who do you like
as the next Treasury Secretary? Did you see the Journal story?
Jay Clayton.
Would you like Clayton? You want John Paul? Would Paulson be a good Treasury Secretary?
There's also another name in the mix.
Well, I was going to say your boss, Jamie Dimon. Do you think that's real? Do you think that's real?
I have no idea. I don't have any inside baseball on that.